If there's a holy grail in stock trading, this might be it. Hey, it's Linus here. Be it whether you're just starting out or you already have some experience in the stock market, we all know that there's no such thing as a holy grail in trading. There's no one particular technical indicator or one specific financial number that we can pay attention to that can magically make us profitable in the stock market. But if a holy grail for stock trading actually exists, this might be it. Because I believe and know it for a fact that if you pay attention to this holy grail and fully understand and master it, you will be profitable in the stock market. So what is this holy grail of stock trading? This is the holy grail, or what I would like to call the holy triangle of stock trading. And if you are trading in the stock market and you are able to master these three components, you will definitely be profitable in the stock market. So let's take a look at what these three components are. So the three components are, first, average losses, the second is average gains, and the third is betting average. So in this video, we'll dive deeper into these three individual components and how you can use it for your own stock trading. The first component in the holy grail or the holy triangle of stock trading is average gain. So what is average gain? So average gain is the average percentage gain of your winning trades. To calculate average gain, we take the overall percentage gain. So we tally up all of your percentage gains on your winning trades and then we divide them by the total number of winning trades that you take. But there are quite a number of people who are confused about how to calculate the average gain. For overall percentage gain, they mistake overall percentage gains for net gains. So what they will do is calculate the overall percentage gains minus the overall percentage loss. But that is net gains, not the overall percentage gains. So for overall percentage gains, we are calculating the percentage gains on all of your winning trades only. That is how we calculate average gains, by taking the overall percentage gains on your winning trades divided by the total number of winning trades. And that is the first component in the holy grail or holy triangle of stock trading. Now let's take a look at the second component. The second component is average loss. So average loss is the opposite of average gain. So what we are calculating is the average percentage loss of your losing trades. Average loss is the opposite of average gains. So what we are calculating is the average percentage loss of your losing trades. So we take the overall percentage loss on your losing trades divided by the total number of losing trades. And similarly, when we are calculating average loss, for the overall percentage loss, we are calculating and adding up the percentage loss on your losing trades only. And after we calculate the overall percentage loss on your losing trades, we divide that number by the total number of losing trades that you made. And that is for average loss. The third one is betting average or win rate. The betting average or win rate of your stock trading indicates how often you are right on your trades. So if you make 100 trades and you're right on 50 of them, your win rate and your betting average is 50%. So how do we calculate the betting average and win rate of your trading? You take the total number of winning trades divided by the total number of trades that you make. So based on the earlier example, the number of winning trades was 50 and the total number of trades taken were 100. So the betting average and win rate for that will be 50 divided by 100, which gives you 50% win rate or betting average. So those are the three components in the holy grail or holy triangle of stock trading. Now, some of you guys might be wondering, why are these so important in stock trading? If you really think about it, at the end of the day, whether you're profitable or unprofitable in the stock market, it all comes back down to numbers. Let me give you an example for simplicity's sake. Let's assume this stock trader only takes 2 trades in a single year. On the first trade, the stock trader is profitable and he makes 50% returns on his first trade. But for the second trade, he is unprofitable. And for the unprofitable trade, he made a loss of 100%. Do you think this stock trader is profitable or unprofitable in the stock market? If you really think about it, it all comes back down to these three components in the holy grail or holy triangle of stock trading. That is average gains, average loss, and betting average. So using the example earlier on, the average gain of the stock trader is 50% because he made 50% on one trade, and for his average loss, it is 100% because on his one losing trade, he made 100% loss. So that is his average loss in that sample of 2 trades. And his betting average or win rate is just 50% because he is right only 1 out of 2 trades. So these are really just the 3 things that you need to pay attention in your stock trading to determine whether you're profitable in the stock market. And if you can understand these 3 things and really master them, you can be profitable in the stock market. And even though I said this is the holy grail of stock trading, it can also be applied for stock investing too. Because even for a stock investor, we are still taking a look at the same 3 things to determine his or her profitability. While the number of positions that a stock trader takes in the stock market in a single year might differ from a stock investor, a stock trader might take more positions in the stock market compared to a stock investor. But at the end of the day, to determine the profitability of the stock trader and a stock investor all comes back down to these 3 main things. And that is why this is the holy grail of stock trading and the only 3 things that you really need to pay attention to. Okay, now let's take a look at another example. So in this example, there are 9 trades in total. And for each trade, I wrote down either the percentage gain or percentage loss. Let's take a look at the average gains first. So what we want to do is tally up the total percentage gains, right? So we add 8.5% to 11.3% to 9.7% and 12.2%. And then after that, after we tally this amount, we divide by the total number of winning trades. So in this case, there were 4 winning trades. So if we tally that up and divide by 4, we'll get 10.425%. And we'll do the same thing for average losses. So we tally up the losses and then divide by the total number of losing trades. So total number of losing trades in this case is 5. So we tally up the total loss, divide by 5, which gives us 4.562%. So average gain in this example is 10.425% and average loss in this example is 4.562%. The next component that we need to calculate is the betting average or the win rate. So in this case, we tally up the number of wins divided by the total number of trades taken. So number of winning trades is 4 and total number of trades taken is 9. So that gives us a win rate of 44.4%. So with these numbers, how do we determine that the trader is profitable or not? To determine whether a trader is profitable or not, using these 3 components, we have to find the expectancy. A positive expectancy is when you get a number greater than 1. So if you get a number greater than 1, it means that you're profitable in the stock market. A negative expectancy, on the other hand, if you're below 1, it means that you're unprofitable in the stock market. So how do we calculate the expectancy of a trader and whether that trader is profitable or not? So we take the average win multiplied by the winning percentage, divide by the average loss multiplied by the loss percentage. So just now in the previous example, we calculated that the average percentage gain was 10.425%. And the win rate or betting average was 44.4%. The average loss we also calculated was 4.562%, and the losing percentage is 56.6%. So how do we derive at 56.6%? We take 100% minus the win rate, and that gives us the losing rate, which is 56.6%. So if we calculate all of that, we get 462.87 divided by 258.21, and that gives us a number of 1.79. So is the trader in this example profitable? Yes, the trader is profitable. Why? Because his expectancy is positive, right? So as we have talked about it just now, an expectancy of greater than 1 is positive, which means that the trader is profitable. So that's how you calculate expectancy and the profitability of a trader in the stock market. And be it a stock trader or a stock investor, to be profitable in the stock market, he or she needs to focus on these 3 things. And if he or she can master these 3 things, he or she can be profitable in the stock market. And this is why this is the closest thing to a holy grail in stock trading. If you have enjoyed and learned something from this video, smash the like button because it really helps the channel grow and allow me to produce more content such as this. And if you are new to this channel and haven't already subscribed, make sure you subscribe to my channel because each week I release new videos about investing, trading, and stock market. I'll see you in those other videos. To your financial success.